Hey there, welcome to Finance 101. If you're just getting started with accounting and finance, you've come to the right place. Today I'll break down 30 essential finance terms in simple language. Let's dive in. First up, an asset is anything of value owned by a person or company. Think of it like your smartphone or a car. This is the opposite of an asset. It's something you owe, like a loan or mortgage. Equity is the value left over after subtracting liabilities from assets. It's essentially ownership in any asset after debts are paid off. Revenue is the money a company earns from its normal business activities like selling products or services. Expenses are the costs incurred in the process of earning revenue like rent or salaries. Profit is what you get when you subtract expenses from revenue. If your income is higher than your costs, you've made a profit. This is the movement of money in and out of a business. Positive cash flow means more money is coming in than going out. A budget is a financial plan that estimates revenue and expenses over a certain period. This refers to the financial assets or resources that businesses use to fund their operations. An investment is an asset or item acquired with the goal of generating income or appreciation. Interest is the cost of borrowing money, usually expressed as a percentage. A dividend is a portion of a company's earnings paid to shareholders. Debt is money borrowed that must be repaid, often with interest. Credit is the ability to borrow money or access goods and services with the understanding that you'll pay later. This is the reduction in the value of an asset over time, usually due to wear and tear. Liquidity refers to how quickly an asset can be converted into cash. This is the price an asset would fetch in the marketplace. Net worth is the value of all assets minus liabilities. This is the difference between revenue and the cost of goods sold. Net income is the total earnings, after all expenses, taxes, and costs have been subtracted from total revenue. This is the money owed to a company by its customers for goods or services delivered. This is the money a company owes to its suppliers for items or services purchased. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholders' equity. This financial statement shows a company's revenue and expenses over a specific period. This statement shows how changes in the balance sheet and income affect cash and cash equivalents. A fiscal year is a one-year period that companies use for accounting purposes. An audit is an official inspection of an organization's accounts, typically by an independent body. ROI measures the gain or loss generated on an investment relative to the amount of money invested. This is the point at which total revenue equals total costs, and the business is neither making nor losing money. These are used to evaluate a company's financial performance and include metrics like the current ratio, quick ratio, and debt-to-equity ratio. And that's a wrap. I hope you found this rundown of key finance terms helpful. Keep these definitions in mind as you continue your journey in accounting and finance. Thanks for watching.